The moment most people ignore. Last month, I logged into my credit card account to do something completely ordinary: pay a bill. Before I could even reach the payment screen, a message appeared across the top of the page. Update your annual income so we can serve you better. It looked harmless. Friendly wording, a clean little box asking for a number. My previous income was already filled in, just waiting for me to replace it with a new one. Most people type the number without thinking. It feels routine, almost polite, like confirming your address at a doctor's office. But that moment reveals something fascinating about the modern financial system. Because when a bank asks for your income, they are not simply updating a customer profile. They are requesting one of the most powerful data points they can possibly have about you. And the second that number enters their system, algorithms begin working. Not algorithms designed to improve your life. Algorithms designed to estimate something very different: how profitable you might be. Once you understand that, the question suddenly feels very different. Why banks want this number so badly? Let's start with a reality most people never question. Banks ask for income information constantly: credit card applications, account update forms, customer service calls, those little pop-ups inside online banking dashboards. But in many situations, especially after your account already exists, there is no legal requirement forcing you to provide updated income. They ask because they want the data. And they want the data because data helps them optimize profit. The moment you submit an income number, your financial profile changes. Behind the scenes, internal systems recalculate your classification as a customer. That single number can influence your credit limit, the interest rate you receive, the types of financial products you are offered, and how aggressively the bank markets additional services to you. In other words, income is not just information, it is a signal, and that signal helps the bank decide what kind of customer you are. The real way credit cards make money. To understand why income matters so much to banks, you have to understand how credit cards actually generate profit. Many people assume banks make most of their money from annual fees. In reality, the majority of credit card profit comes from interest, and the scale of that interest is enormous. According to Federal Reserve consumer credit data, credit card debt in the United States recently exceeded $1.2 trillion. That means more than $1 trillion of revolving balances generating interest every single month. And the interest rates attached to that debt are not small. Bankrate's National Credit Card Survey shows the average credit card APR hovering around 20%. But for customers who actually carry balances, the effective rate can exceed 22%, according to Federal Reserve analysis cited by NerdWallet. Those numbers become far more dramatic when you run the math. Imagine an ordinary scenario. Someone carries a balance of roughly $6,500, close to the typical balance reported in consumer debt studies, at a 22% interest rate. If that person only makes minimum payments, the total repayment cost can more than double. In one typical repayment timeline, that $6,500 balance can generate more than $7,000 in interest alone and take nearly 8 years to eliminate. That is the compounding shock most people never calculate. A single balance quietly produces thousands of dollars in profit for the bank. Multiply that across millions of accounts, and the scale becomes staggering. This is why banks are so interested in understanding customers. Income helps them estimate future behavior. The credit limit psychology trap. One of the most obvious places income data shows up is in credit limits. When a bank knows your income, it has a rough estimate of how much credit you might theoretically handle. Higher income usually leads to higher credit limits. On the surface, that seems logical. Someone earning $150,000 per year probably has greater borrowing capacity than someone earning $40,000. But behavioral economics tells a more complicated story. When people are given higher credit limits, spending often increases. Not necessarily because they consciously decide to borrow more, but because the psychological ceiling moves. A $5,000 limit feels restrictive. A $30,000 limit feels comfortable, and that shift changes behavior. Banks understand this dynamic extremely well. Higher limits create the possibility of larger balances. Larger balances produce more interest payments, and interest payments are where the real revenue lives. The quiet pricing strategy most people miss. Income data also feeds into something far less visible: pricing strategy. Many people assume interest rates are determined entirely by credit risk. Higher income should theoretically lead to lower rates, but pricing models in modern finance often consider another factor called price sensitivity. Different customers react differently to price changes. A borrower earning $40,000 per year might notice the difference between a 17% interest rate and a 21% rate immediately. Someone earning $200,000 may not bother switching lenders over a few percentage points. From a behavioral standpoint, the cost difference simply feels smaller relative to their income. Banks know this, which means income can influence how products are priced. Inside the industry, this concept sometimes appears in models known as ability to pay pricing. The logic is simple: charge what the customer can afford without losing their business. That does not mean every high-income borrower receives worse terms, but it does mean income becomes one of several variables in the pricing equation. How income shapes marketing targets. Income also plays a major role in marketing. Once your income is known, the bank can categorize you more precisely. Higher income customers often receive offers for premium credit cards featuring airport lounges, travel rewards, concierge services, and annual fees that can exceed $500. Lower income customers often see a different set of offers: balance transfer promotions, personal loans, and credit line increases. Some of these products can be useful financial tools when used carefully, but they can also encourage additional borrowing. And because the targeting process is algorithmic, the offers are rarely random. They are calculated. The data that never disappears. There's another detail many people overlook: longevity. When you tell a bank your income, that number rarely disappears once your application is approved. It remains in your customer profile, sometimes for years. Financial institutions maintain massive databases of customer information. A number you entered into a form 5 years ago may still influence how algorithms categorize you today. That classification can affect decisions you never see: credit limit adjustments, marketing campaigns, risk assessments during economic slowdowns. A personal lesson about financial data. At this point, I should probably share something personal. There was a period in my life when I was constantly receiving calls from credit officers representing different banks. They invited me to open credit cards with high limits, promising low interest rates, cashback rewards, travel perks, and all kinds of financial benefits. On the surface, those offers sounded attractive, but what struck me was how much they seemed to know about me already. They clearly had access to various pieces of financial information: details about my income level, my salary patterns, and even some of my bank transfer activity. That data had likely been gathered from different financial databases and internal systems used within the banking industry. Sometimes it felt convenient, but other times it felt uncomfortable. Because the more those calls continued, the more it felt like pieces of my personal financial life were circulating somewhere outside my control. Then one day, something even stranger happened. I received a notification about a balance on a credit card account. The problem was simple: I had never opened that credit card. I had never applied for it. I had never even spoken with anyone about activating it. Yet the bank's system showed that a credit card had been issued using my personal information, and there was a small balance attached to it. The amount itself was not large, but the situation was serious. It meant that someone had used my personal data to create a credit account without my confirmation. I immediately contacted the bank to report the issue. After investigating the situation, they confirmed that a credit representative had improperly used my personal information without proper verification procedures. To their credit, the bank cooperated with me to resolve the situation and close the account. But that experience left a lasting impression. It reminded me that personal financial data is far more powerful than most people realize. Income details, identity information, transaction records, these are not just numbers inside a system. They are keys that can open access to credit lines, financial products, and sometimes even problems if they fall into the wrong hands. That experience taught me an important lesson. Protecting your financial information is not just about privacy. It is about control. The era of data-driven banking. Modern banking runs on data. Customer information has become one of the most valuable assets in the financial industry. Every additional data point improves predictive models, predicting behavior, predicting risk, predicting profitability. From the bank's perspective, collecting more data simply improves the business. But for consumers, it raises an important question. How much information should you actually share? In digital privacy discussions, there is a principle called data minimization. The idea is simple. Provide the information required to complete a transaction, but avoid sharing unnecessary data that does not benefit you. In banking, that might mean reporting income accurately when applying for a mortgage or loan that legally requires verification, while declining optional updates that primarily serve the institution requesting them. The simple question that changes everything. None of this requires hostility toward banks. Banks provide important services. Credit systems help people buy homes, fund education, and manage emergencies. But banks are also businesses, and businesses optimize profit. Understanding that reality simply helps you navigate the relationship more intelligently. The next time you log into your banking app and see a message asking you to update your income, pause for a moment and ask yourself a simple question. Does sharing this information benefit me right now? If the answer is yes, perhaps because you want a higher credit limit or you are applying for financing, then updating the information may make sense. But if the answer is no, you can simply close the message. Your account will continue functioning exactly as before. Your payment history will still determine your credit worthiness, and the bank will simply have one less piece of data feeding its algorithms. In a financial system increasingly powered by data, even small choices about personal information can matter. Sometimes the most powerful financial strategy is surprisingly simple. Provide what is required, protect what is optional, and let your financial behavior speak louder than any number in a form. Thanks for watching.